Hello and welcome to a brand new episode of Up Close and Personal with Finance. Today I'm joined by the wizard of Dalal Street, Mr. Raamdeo Agrawal of Motilal Oswal. When it comes to stocks that we've seen, such as Aisha, Page, Titan, all stocks that possibly every investor would like to hold at some point. But what would you advise investors to do? Would you advise them to look for opportunities to enter these stocks, or would you say that to focus energies on finding the next mid to mega stock?
See, every investor will have his own set of circle of competence, within where he can find his own 10, 15 stocks. So the stocks which you said, they are winners of yesteryears.
Yes.
And they might be winners again, in next 10, 15 years.
Correct.
Some of them definitely.
Correct.
So, but then for me to buy and make money out of that, I have to understand that very well. See, you cannot make money by listening to somebody.
Absolutely.
You have to understand from within that, okay, I am buying Reliance at 3 lakh crores or some, whatever, any of the companies say, Aisha at 52,000 crores or 60,000 crores. So you have to understand that at this price, it's a deep value and it is going to be 5x or 10x in next 5 years. So that understanding has to be there. And after that, it doesn't matter what stock you're buying.
The other concept that you've often spoken about is value migration. And one example you usually give is the value migration from PSU to private sector banks.
Yeah.
Aside from that, anywhere else you see this kind of value migration possibly happening in today's environment?
Yes, many places, like Indian pharma. So Indian pharma is about the ones which are being exported. So that is all the European companies, they used to make it for America. And now that Israeli or American, European companies which used to make the generics, now that is being made in India. So it's a completely migration of, see this Teva and all these companies, they were from European kind of a background. Those companies are now giving shares to the Indian companies. So all these Indian companies, Sun Pharma, Lupin and all these companies are basically copying what other companies were doing earlier. So that's a huge value migration, global value migration. Your ultimate mother of all the value migration is IT, which is Boston to Bangalore. So, and there are many more like this small value migrations which are on. Telecom from wired to wireless. This was a complete technology shift. Then you talked about PSU to private sector banks, which is on and it will go on for next 10, 15 years. But still your PSU structure is 2/3 and private is 1/3.
Yes.
My sense is in 10 years it will be just the reverse.
Right.
So a lot more is yet to happen.
Right.
You keep seeing this. I mean, even in airlines, from full service to discounted,
Correct.
The whole industry is moved from full service to now discount. Everybody is low cost.
Right.
Yeah.
Right. Let's talk about the India consumption story, which you've also been saying that it still has to be, still has to play out.
Yeah.
So again, you've got stocks like Britannia, Emami, Nestle, all of these stocks. My question here is, assuming consumption in these products does see a jump, given the valuations currently, how much should one be willing to pay up for that potential jump in consumption going forward?
Yeah, see, it is all in the warm up future. We don't know how much, how rapidly economy will grow, how rapidly the discretionary will grow, and this particular category will grow. One thing is for sure that they will grow.
Right.
So we have to see in last 15 years or 10, 15 years how they have grown. So some say Britannia has grown about 10%, Nestle has grown about 12, 13%. So I don't see any reason why in next 10, 12 years they will not grow at least at this pace, if not faster.
Okay.
But now that can be a little slower and that can be a little faster than faster. So most likely, and then what is the inflation built in? So in the past we had 7% inflation, 8% inflation. So the total given profit 12 plus 7, so that makes about 19-20% for Nestle. So the stock also returned about 20-21%. But if by chance the actually nominal growth is 14-15%, so you are likely to make about 14-15%.
Right.
So it all depends on, see, if you buy expensive, clearly your return is going to be growth minus, say earnings growth is 20%, there will be some reduction in that because the PE derating is going to happen.
Right.
So, and if you buy very cheap, in that case it's growth plus. If you say if you're buying at 15 PE or 20 PE, it goes to 40 PE. So obviously in 10 years, you get another 5-6% on top of say 20% growth, so you'll make about 26-27%.
Right.
So what is important is to see, so clearly these stocks are expensive. So my sense is on 5 or 10 year basis, you'll get growth minus something.
Okay. Going back to the point you were mentioning about low interest rate environment, which we are in currently world over. How has that impacted in fact the entire concept of investing or picking stocks? How have you adjusted in your experience?
our return requirement is same. I mean, we want to make 20, double in 3 years, 25% compounded. So that remains same. But the issue is that how the market is going to kind of discount. Basically, what is built into the current price and how the market will value it, 3 years, 5 years henceforth. So if the low interest rate environment remains, prevalent and say discount rate. So basically what happens is the given earnings are discounted a lot more easier. So if my interest rate environment is 10%, so my discounting will happen at about 15%. So I'll get for a same amount of earnings and growth, I'll get say 15p multiple.
Right.
But if the interest rate comes down to say 5%, in that case my discounting rate will go down. And hence for the same earnings and earnings growth, I may get a p multiple of instead of 15, I may get 25 or 30. So the same company looks more valuable if the underlying discount rate is low for a pretty long period. See, this time discounting rate is not low for 1 or 2 years. I mean, the whole 10-year bond, almost $13 trillion or over that, is 10-year papers are now below, kind of sub-zero. So it looks that world is in for a prolonged period of low interest rate, and hence equities are looking much more attractive in the world over. I mean, most of the markets are all-time high, despite the economy underlying are not doing so well.
Correct.
So clearly, the companies which are actually doing very well, they deserve to get fantastic valuations.
So how much of a divergence do you think there is between where our stock markets are in India versus the fundamental underlying economic story?
It's not exorbitantly priced right now. I mean, the way people are getting scared or something like that. But can it correct by 10%? Of course, there is always scope for 10% correction from any level. So yes, it can correct by that much, but there is equally good chance that it might blow out by another 10%.
Right.
So at 70% to GDP, our market cap is about 110 lakh crores. Our GDP is about 145 lakh crores, and we are growing at about say 10% nominal GDP. So next year it will be 160. So on a 12 months basis, you again come back to more like 62, 63%. So I'll be very surprised. Markets can correct in between, but after a year, I mean, if you give a 12 months time, will it be significantly below? Very unlikely. With a good monsoon, low oil prices, current account deficit under control, fiscal under control, government getting aligned to doing, I mean, all the policy paralysis over, world is in low interest rate situation. Right. So, I mean, selectively if you buy, see what is happening is that almost 2/3 of the index companies, 2/3 of at least of the market cap of the index companies, they are actually in low growth situation. Only 1/3 of them are growing. So index is looking very, for the given growth, index is looking very frothy in the sense that index is looking very tired at about 86, 8700. Right. Whereas the companies which are growing, they are in a full swing. And that's what is going to happen. So my sense is still, say for next 2 years, by chance the broad-based economic growth doesn't happen. It remains 5, 6%, 7%, or it doesn't just take off. I mean, anything can happen, but if by chance it doesn't take off, in that case, market may stay here or market may give a very marginal gain in terms of percentage index gain. Right. But I'm quite sure the kind of excitement which is there in the market with the say mid-cap stocks or select even large-cap stocks, I think we'll have good time. So it is a stock picker's paradise, and the active investors who are there, who can pick a stock, who can build a good portfolio. There can be a mistake in 1 or 2 here and there, but those who can make a good portfolio, I think they will have good time with a very limited downside.